Hello, this is Company J with BSG. This is Joshua Coates.
Jen Smith.
And I'm Katie Kaufman.
First off, we're going to talk about our strategic plan for our company. Our strategic plan emphasizes four key objectives designed to address recent performance challenges and align with our long-term goals. First, we aimed to increase profitability and operational efficiency across all markets by streamlining processes and optimizing resources. Second, we are focused on expanding market share in underperforming segments, such as Europe, Africa, and Latin America, where significant growth opportunities exist. Third, we plan to leverage value chain efficiencies to sustain cost leadership, ensuring competitive pricing while maintaining strong profit margins. And then lastly, we prioritize product differentiation to outcompete rivals and meet consumer expectations for quality value. Our market-specific strategies in North America, we are committed to improving productivity, market share, and cost management. While productivity levels have remained consistent, labor costs are notably high. To address this, we plan to invest in automation and implement lean production systems to enhance efficiency. Market share growth will be driven by strategic marketing campaigns in both internet and wholesale channels, strengthening brand loyalty and attracting new customers. Additionally, our cost management strategy will focus on balancing workforce size with training initiatives to improve per unit efficiency. Supply chain and logistics will also be optimized to reduce material waste and ensure lower production costs. In Europe, Africa, the strategies were to offer substantial growth potential, and we intended to maximize our SQ quality rating in this region. We prioritize investments in R&D to enhance product quality and differentiation, enabling us to compete more effectively in premium segments. Profit margin growth will be driven by premium pricing strategies, particularly in the internet channel, where quality-conscious consumers are willing to pay higher prices. To expand our market presence, we will strengthen partnerships with major distributors and increase digital advertising to attract high-income consumers. These initiatives will position us strongly for growth in this region. In the Asia Pacific, the strategy was focused on market expansion, cost reduction, and improving the SQ rating. The region's growing middle class presents an opportunity for us to offer affordable branded products tailored to local preferences. Competitive pricing will play a key role in penetrating underdeveloped markets. To reduce cost, we planned to invest in local manufacturing facilities, which will minimize logistics expenses and import duties. By standardizing production processes across facilities, we can ensure uniform quality while maintaining cost efficiency. To address the decline in SQ ratings, we will allocate resources to R&D and production training, strengthening our competitive edge in this dynamic region. In Latin America, we saw significant growth opportunities, but we also faced intense competition from private label brands. Our strategy in this region emphasized wholesale and internet channels with a focus on offering region-specific designs that appeal to local tastes. To drive operating profits, we will leverage economies of scale by increasing production volumes and low-cost facilities. Our value chain will serve as a cornerstone for achieving operational efficiency and cost leadership. Inbound logistics will be optimized through bulk purchasing agreements and favorable supplier contracts. In operations, we will leverage automation to boost productivity and reduce reliance on high-cost labor. Outbound logistics strategies will focus on optimized inventory levels to minimize holding costs and prevent stockouts. In marketing and sales, we will ensure that resources are allocated effectively through data-driven campaigns that target high-value customer segments. These initiatives will collectively enhance our competitive position in the market. As far as maintaining cost, our strategy for maintaining costs revolved around process optimization, workforce development, and technological innovation. By streamlining workflows and eliminating inefficiencies, we tried to improve our cost structure. Employee training was also a focus. We wanted to enhance productivity and ensure our workforce is equipped to meet operational demands. A lower price point strategy will enable us to compete aggressively in price sensitive markets without sacrificing profitability. Additionally, we will integrate robotics and other automation technologies to handle repetitive tasks, reducing labor costs and increase efficiency as well. As far as our achievements and challenges, the challenges we faced in our company were we were late to expansion in the Europe, Africa, and Latin America regions. So we missed out on a lot of sales because we did not expand at the right time. We did really well in the other two regions, but because we were late, it really slowed our profitability and our sales. Declining SQ ratings in Asia Pacific and Latin America also pose a significant risk as quality conscious customers may have turned to our competitors. We also had high labor costs throughout the 10 years across all 4 regions. This placed pressure on our profit margins, and our market share in both the internet and wholesale channels showed little to no growth throughout the 10 years. These challenges highlight the importance of our proposed strategic initiatives in driving success and ensuring long-term competitiveness.
Okay, so for our achievements, other than market share, our financial ratios managed to steadily increase throughout the game. EPS went from 1.83 to 6.18, marking a 30% increase. Stock price rose 27%. It had quite a large jump between 19 and 20 from 73 to 111. And then also throughout the game, we held a fairly high credit rating, but the last 2 years we did have an A+. Okay. In regard to production strategies, we invested in best practice training for our employees. We believe this is a high priority to teach them most efficient footwear methods and reduce waste. We also kept liabilities low, did not use extensive borrowing during this 10-year period. We decided not to build additional space in our warehouses. We used other methods to effectively use our space and save costs. We did this by revisions to plant layouts. This helped us reduce setup costs by approximately 50% in both North America and Asia Pacific regions. For our competitive strategy, we kept compensation at or slightly above the industry average. We also believe that investing in fringe benefits and incentive programs will contribute to the employee retention. We also utilize mail-in rebates to exceed the competition. Also, advertising was a large part of our competitive strategy. This was done in both wholesale and internet segments.
The next few slides will talk about our financial performance. Here is a trend of our earnings per share for years 10 through 20. We did not always meet the investors' expectations, but we did see overall growth. We had a slight dip in year 14, but improved in the following years. We started year 10 with an earnings per share of $2, and by year 20, earnings per share had improved to over $6. And next, we'll look at our return on equity. Again, we see upward overall trend line. Similar to earnings per share, we had a dip in year 14, but improved in the following years. By year 20, we reached a return on equity of 23.4%. We had a little more volatility with our stock price. There are larger swings from year to year, but again, we had an overall favorable trend. At our lowest point, stock price dropped to 12.62 in year 11, but jumped up to $111 by year 20. And then looking at net revenue, year over year, you can see we had significant improvements up until year 15, but then the net revenue started to drop. Overall, we still had a positive trend, but this would be something to be concerned with had we continued with the company for additional years. Going through this process, there were definitely some lessons learned. First thing is to pay attention to demand. In early years, we were overproducing and not realizing we could save some of that product for private label. It's also important to see the trends in the industry. Comparing our results to the other companies in the game helped us understand some of the challenges that we needed to, some of the changes that we needed to make. And then lastly, and most importantly, is teamwork is key. It's hard to say one person should focus on earnings per share while someone else focuses on image ratings or another aspect, because the changes you make in one area impacts all areas of the game. And this is important in the real world too. With any company, it's important that all departments work well together. You cannot have finance with one set of goals and marketing with something completely different and expect to have unity. It's important to follow the same strategy throughout the organization. And this concludes our presentation. Thank you from Company G. Jay.
Thank you.
Thank you.